We probably characterize it as being challenging in a very difficult market environment. But I think if you look commercially for ING in Q4, we continue to show positive momentum with additional 200,000 new primary customers being added. I think overall we now have 38 million customers with us worldwide. And what we see is that our customers are becoming significantly more digital than they were the same period last year, with over 37% of our total active customer now interacting with us in a digital mobile way, right? And that has resulted in our top line, particularly net interest income and fee incomes growing year on year. And as you mentioned at the top of your show, indeed, our costs are rising due to some projects related to our anti-money laundering enhancement program, and we have seen somewhat of an uptick in terms of risk costs.
The regulatory rise in costs is something that I think is being experienced across the European banking sector with some frustration, particularly in an environment of low interest rates and challenging economic growth. Tanate, is there anything that you can do to bring these costs down as we run into the first and second quarters of 2020? Because it feels as though the investors are becoming increasingly sensitive to banks and their ability to execute where they can on self-help around costs.
That's a major component of our cost now, regulatory expenses. I think it represents over €1 billion of expenses for ING Group in 2019. And it's one of the things that we have to do ourselves in terms of managing the size of our balance sheet, where we do business and how we do business. And I think we need to focus, apart from looking at the revenue side, on cost efficiency, where we have a number of programs to make sure that at least on the underlying cost basis, we continue to keep costs under control. And if you see for the full year 2019, ING, excluding these regulatory expenses, has a cost-income ratio of 51.5%, which is within our target range.
Can I ask you about the net interest margin? Because you have mentioned in the numbers today that's holding up. You've also cited some price discipline and tiering. How much of this is down to just further broader reach on distribution, where you can chase much firmer interest rate levels than what you've got here in Europe?
Yes, the big drag in terms of interest income is really the negative interest rate in some of our major home markets like the Netherlands, Belgium and Germany. But we have also seen good pricing discipline across our franchise, across all asset classes. We have also seen the company change its asset mix, where we have now much more, for example, consumer loans compared to certain asset classes. And we have seen diversification away from the Eurozone into Central Europe, Asia, and other parts of the world where the interest curve remains positive.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.